The money machine, hidden behind a candy store. A 12-year-old kid sat behind a candy stand after school, counting coins in a dusty plastic jar. Some days he sold out, others he barely made enough for a Slurpee. But what happened next would teach him, and eventually the world, a lesson about money that most adults never learn. One summer, he sold his tiny candy stand to a friend for $100. 3 months later, that friend flipped it for $200. Same stand, same candy, same customers. Nothing had changed except perception. One saw candy, the other saw cash flow. That second kid, he didn't just grow up, he grew rich. Because he realized what looks ordinary to most can be a money machine to those who understand what to look for. And behind many simple, boring businesses lies an engine of wealth most people walk right past. Here's the shocking truth. In 2025, while most people chase crypto headlines or TikTok stock tips, a quiet group of investors are quietly compounding their wealth using a method so simple, it almost feels illegal. They aren't predicting markets. They aren't trading daily. They aren't even that smart. But they are using a strategy built by a man named Joel Greenblat, one that turned $1 into $30 over 17 years. It's been copied, ignored, rediscovered, and misunderstood. But what if we could decode it, not just logically, but emotionally? Not in finance speak, but in real human stories. This isn't a finance lesson. It's a treasure map disguised as storytelling. If you've ever felt like Wall Street was built to confuse you, this series is the key they hoped you'd never find. And in today's episode, we'll walk through the first clue. Why most people completely misread the value of what's right in front of them. Because before you can use the machine, you need to see it. The gum shop parable. Imagine you walk past a little gum shop every day. It's not flashy. Just a faded sign, a bell on the door, and the scent of sugar wafting out. Most people ignore it. They see a place that sells 25-cent candy and old soda cans. But one day, someone sees something else. They run the numbers. They realize the shop brings in $50,000 a year. The rent is cheap, the overhead is low, and the owner wants to sell it for $30,000. That's when a quiet truth hits. This isn't a candy store. It's a money machine. You're paying $30,000 for something that gives you $50,000 a year. You just bought a vending machine that prints cash. The big idea here is one of the most misunderstood in investing. Businesses aren't just stories or brands or logos, they're machines. And just like any machine, what matters is how efficiently they work. That gum shop might not be glamorous, but it produces more return per dollar than most tech startups. Joel Greenblat's genius wasn't inventing a new machine. It was showing people how to measure two things: how profitable a business is and how cheap it is to buy. That's it. And yet almost nobody does it. Why? Because we're hypnotized by shiny things, stories, trends, logos. But the gum shop teaches us to ask the only question that matters. What do I get back for every dollar I put in? Let me take you into a real story. In 2004, a small private equity firm bought a rundown collection of gas stations across the Midwest. No tech, no patents, no hype. Just convenience stores with foot traffic. They looked boring, but they were cash cows. Bought for $5 million within 3 years, they were earning over $1.2 million annually. That's a 24% return every year. The investors didn't buy a business. They bought a vending machine for cash. While others chased unicorns, they quietly compounded wealth. Here's the deep insight. Most people think investing is about predicting, timing, luck. But Greenblat flipped the lens. He taught us to look not at what might happen, but what is happening. The gum shop already prints money. You don't need a crystal ball to see that. You just need to know how to count the gum. Have you ever overlooked something simple because it seemed too small? Have you ever passed on an opportunity because it didn't feel exciting enough? What if, just once, the boring thing was the right thing? What if your money's best future was hidden inside a forgotten candy shop? But here's where it gets even more interesting. Because once you understand what a good business looks like, the next step is learning why the market constantly misprices them. And that opens the door to your first real advantage. The mood swings of Mr. Market. Picture this. You have a business partner. His name is Mr. Market. Every morning, he knocks on your door and offers to either buy your share of the business or sell you his. But here's the strange part. His mood changes drastically every day. One day, he's ecstatic. He offers you $1,000 for your share. The next, he's depressed, insisting it's only worth $400. His offers swing with the wind, the news, the gossip. Most people would think he's unstable. But here's the key. You don't have to respond. You can choose when to buy, when to sell, or when to do nothing at all. This was one of Benjamin Graham's greatest gifts to investing, a character called Mr. Market. But Joel Greenblat didn't just repeat the metaphor, he weaponized it. Because in real life, Mr. Market isn't a person. He's everyone else. He's media hype, Wall Street noise, your friend texting you about the next big stock. He's fear. He's euphoria. And he never shuts up. But the smart investor, the one who builds wealth quietly, doesn't argue with Mr. Market. They wait for him to have a breakdown, and then they make their move. Let me tell you about Sally. In 2020, during the first COVID crash, she watched her company's stock fall from $68 to $29 in a week. It was a boring logistics firm, still profitable, still delivering every day. But the market panicked. Everyone sold, except Sally. She bought more. In 2 years, the stock rebounded to $91. She didn't time the market. She just waited for Mr. Market's next meltdown and bought when he was crying. Here's what most people miss. Stock prices move every day, but business values don't. That gum shop we talked about? It still earns $50,000 a year, whether someone offers you $20,000 or $200,000 for it. Mr. Market is your manic business partner, there to serve you, not guide you. And once you understand this, you stop being a puppet and start being the puppeteer. The modern context? In 2025, markets are more emotional than ever. With Reddit-driven spikes, AI-generated trading models, and constant noise, Mr. Market has gone from bipolar to borderline insane. That's your opportunity. Because when others are jumping in and out, you're sitting still, waiting for value to scream through the fog. Now, pause for a second. Have you ever sold too early just because the price dipped? Or worse, bought something high because everyone else did? We've all danced to Mr. Market's mood. But what if from now on, you simply let him talk and waited for the perfect offer? Because if you think this lesson was eye-opening, wait until you see what happens when we combine it with the two numbers that can predict long-term success. That's when the machine really starts to hum. The two levers of infinite returns. If someone handed you a machine that spits out money every month, what would be the first thing you'd ask? How much does it cost? Or how much does it produce? Now, imagine that machine is a business. And your ability to become wealthy depends on understanding just two levers, how profitable the machine is and how cheaply you can buy it. That's it. No charts, no gurus. Just two numbers, one that tells you how fast money flows out and one that tells you how little you had to pay for that privilege. Joel Greenblat boiled decades of investing down to two simple measurements. The first is return on capital. How good is this business at turning its own money into more money? The second is earnings yield. How cheap is it to buy those profits today? Put simply, great businesses with high returns on capital are rare. But when you find one that's also selling at a discount, that's the holy grail. Let's anchor this with something real. Imagine you're buying a laundromat. One earns $50,000 a year and costs you $1 million. Another earns the same $50,000, but only costs $250,000. Which one would you buy? Obviously the second one. But here's the twist. On Wall Street, most people buy the first one. Why? Because it has a shinier logo. Because an analyst recommended it. Because it's trending on a subreddit. The truth is, they've forgotten what they're actually buying. A machine that prints money. And they've stopped asking the only two questions that matter. How good is this machine? And how cheap can I get it? Here's a real-world case. In 2011, Apple had an insanely high return on capital, but for a brief moment was trading at an earnings yield that made it look like a grocery store. The market was panicking about Steve Jobs' health. People were dumping the stock. But those who focused on the levers, the actual math, saw an underpriced money printer. By 2015, they weren't just right, they were rich. The deep wisdom? Most investors confuse activity with intelligence. They think success lies in speed or complexity. But wealth comes from knowing when the numbers quietly whisper, this is a rare moment. This is a broken price tag on a brilliant machine. Now ask yourself, have you ever bought something just because it looked hot? Ever skipped a boring stock because it didn't make headlines? What if, from now on, you focused only on businesses that actually produced wealth and bought them when the price was wrong in your favor? Because here's where the story really bends. Once you learn to identify these machines, the next lesson is even more powerful. Why buying only great machines isn't enough, and how to time your entry without ever watching a clock. The trap of good businesses at bad prices. There's a strange tragedy in investing. It's when someone finds a wonderful business, respected brand, stellar products, loyal customers, and still loses money. How? They paid too much. It's like buying a Rolls-Royce for $1 million, and discovering its resale value is only 400 grand. Beautiful ride, horrible investment. This is the trap most investors never see coming. They think good company automatically means good investment. But Joel Greenblat shattered that illusion. He reminded us, even a perfect money machine becomes useless if you pay too much to own it. Think about it. Would you pay $100 for a gumball machine that only makes $1 a year? That's a 1% return, worse than a savings account. But if you paid $10 for the same machine, now you're getting 10%, same machine, different outcome. The only thing that changed was the price. Let's go to the real world. In late 2021, Tesla was the darling of the market, a phenomenal company, industry shifting, beloved by retail investors. But its price had soared so far beyond its earnings, it was like paying for 20 years of profits in advance. When the euphoria cooled, the stock fell over 60%, not because the business was broken, but because the market woke up. Investors paid too much for perfection, and perfection doesn't last forever. Here's the emotional sting. We fall in love with great stories. We want to own pieces of genius, but money doesn't care about love. It cares about price. And even a brilliant company can become a bad deal when that price tag is out of touch with reality. The insight? Don't just ask, is this a good company? Ask, is this a good deal today? That candy shop from before, it's still a cash machine. But if someone tries to sell it to you for $1 million, it's no longer a gift. It's a joke. Now turn inward. Have you ever bought stock in a company just because you admired the brand? Ever assumed quality meant safety? What if, from now on, you learn to love the math more than the marketing? Because the next insight changes everything. It reveals why markets constantly misprice even the best machines, and how to use that chaos to your advantage. The mirage of Wall Street expertise. Imagine walking into a casino where the dealer is always smiling, always polished, always confident, and always winning, until you peek behind the curtain and realize he's broke. That's Wall Street, a place that looks like it knows everything, but in reality, consistently loses to people who follow a simple plan with discipline. Joel Greenblat didn't just develop a strategy that worked. He proved that even elite professionals often fail to outperform the market. And here's the kicker. He didn't hide it. He handed the strategy to his own students, literally gave them the formula. And what happened? Some ignored it, some tinkered with it, others gave up too early. Only a handful stuck with it, and they beat everyone else. Why? Because it wasn't the complexity of the strategy that made it powerful. It was the commitment to follow it without ego. Let's look at something shocking. Between 2001 and 2016, over 85% of active fund managers, people paid millions to pick stocks, underperformed the S&P 500. These are Ivy League grads, MBAs, analysts with access to the best tools. Yet they lost to the very index they were supposed to beat. Why? Because even the smartest people in the room can't escape emotion. They chase returns, they panic, they try to outthink the machine, and the machine doesn't care. Now think about this. You, sitting at home, can quietly beat the market if you follow 2 levers and 1 formula. Meanwhile, the pros, on the 47th floor of some Manhattan skyscraper, keep guessing. It's not intelligence that wins, it's emotional control. Consider the story of a young investor named Eli. He followed Greenblat's strategy, built a 25-stock portfolio using the magic formula, and didn't touch it for 5 years. He didn't watch CNBC. He didn't listen to gurus. He ignored Wall Street noise. His return? 16.5% annually, far above the market average. His secret? Not skill, not speed, silence. This is the wisdom bomb. The more you think you need to act, the more likely you'll fail. Complexity doesn't guarantee performance. Clarity does. And Wall Street thrives on making things feel complicated. Because if you believe it's too hard, you'll hand them your money. Now, ask yourself, have you ever thought, I'm not smart enough to manage my own money? Have you ever handed control to someone else because they wore a suit or used big words? What if, starting today, you realize that simplicity, applied with discipline, is stronger than any credential? But there's one more layer. Even if you believe in this strategy, there's a reason most people still fail to stick with it. And once you see why, you'll understand the true enemy isn't out there, it's within. The curse of quitting. Too soon. There's a bitter irony in investing. The very strategy that can make you wealthy often feels like it's not working right before it does. It's like planting a tree that grows underground for 3 years before ever showing a leaf. Most people stare at the dirt and give up, right before it breaks through. Joel Greenblat's formula isn't just a system, it's a psychological test. Because while the numbers make perfect sense, the emotions betray you. The truth, most people can't stomach underperformance, even when they know what they're doing is right. And Wall Street is counting on that. Here's a painful story. In 2005, Greenblat ran a fund based entirely on his own formula. It had proven itself for years. But in the first 12 months, it underperformed the market. Investors panicked. They pulled out. The headlines whispered, "Has the magic worn off?" But the formula didn't change. It didn't panic. It simply waited. And over the next 3 years, it crushed the market. Those who stayed were rewarded. Those who left, they locked in losses. Because in investing, your worst enemy isn't volatility. It's impatience. The human brain hates being wrong, even temporarily. When your stock lags behind your neighbor's crypto gain, when CNBC says value is dead, when the world moves faster than your quiet little machine, you question yourself. And that's when most people quit, not because the strategy failed, but because their faith did. Here's the deep truth. The magic formula doesn't just pick stocks, it picks investors. It tests who can trust a process when it's not trendy, when it's not exciting, when it's downright boring. It rewards those who act like owners, not speculators. Let me introduce you to Lisa. In 2017, she built a 20-stock portfolio using the formula. Year 1, slightly down. Year 2, flat. She doubted herself, but stayed the course. Year 3, plus 22%. Year 4, plus 118%. Year 5, plus 30%. By year 6, she didn't just beat the market, she beat the noise, the doubt, and her past self. And it changed her life, not just financially, but emotionally. She no longer needed to react. She had peace. Now, take a breath. Have you ever abandoned a plan because the results didn't come fast enough? Have you ever looked at a loss and felt shame instead of patience? What if, from now on, you viewed time not as an enemy, but as your secret ally? Because next, we explore how to build your own 30-stock freedom engine, and more importantly, how to make it bulletproof from your own instincts. Building your 30-stock freedom fund. Let's imagine you're building a money machine, not a hypothetical one, but a real digital machine that lives inside your investment account. It hums quietly in the background. You don't touch it. You don't tweak it. You don't panic when it stalls for a moment. You just trust that, over time, it's doing exactly what it was built to do. Turn small dollars into big freedom. That's what the Magic Formula portfolio is. A silent engine for wealth, built not on genius, but on structure. Greenblat's strategy isn't just theory. It's executable. Right now. Today. In 2025, you can build this machine with nothing but discipline, a spreadsheet, and 20 minutes. You start by screening for 2 metrics, a high return on capital and high earnings yield. The companies that score well on both, they go on your buy list. Then you spread your investment across 20 to 30 of them, equal weighted. Every year you replace the old with a new batch. That's it. No daily trading, no market watching, no gut feelings. Just a mechanical rotation once or twice a year. Let's bring this into focus. A user named Kevin on an investment forum shared his journey. In 2019, he built a 25-stock portfolio using a free tool inspired by Greenblat's website. He held it, rebalanced it once a year. No watching, no drama. In 2024, he posted an update. His portfolio had outperformed both the S&P 500 and his former mutual fund, with half the volatility. His secret, not intelligence, immunity from temptation. The modern edge, In 2025, tools like AI-based screeners and platforms like magicformulainvesting.com make it even easier. You don't have to be a CFA. You don't have to read annual reports. You just need a system and the ability to let it breathe. Here's the wisdom bomb. Wealth isn't built through action. It's built through structure. You don't win by predicting, you win by preparing. And preparation means setting the rules before emotion enters the room. So, let's reflect. Have you ever built something so sturdy it could run without your supervision? Have you ever let a strategy do the work, even when your gut screamed to interfere? What if this year, your 30-stock machine became your quietest, smartest employee? But as strong as that sounds, there's still one problem left. Even when people build the machine, they often sabotage it. Why? Because when the market moves, the mind panics. And in the next insight, we'll uncover the internal war between logic and emotion, and how to win it without ever having to fight. The math versus the mind. You can have the perfect plan, the right stocks, the clearest formula. But if your brain rebels at the wrong moment, you lose everything. Because in investing, the most dangerous opponent isn't the market. It's the voice inside your head whispering, "This isn't working." This is where most investors fall, not on spreadsheets, but on feelings. Joel Greenblat understood this. That's why he built a system simple enough that even a child could follow it, but hard enough emotionally that even adults rarely do. Because when your portfolio dips 8% while the market is up 3%, math doesn't comfort you. Panic does. And panic destroys the machine. Let me show you the paradox. Greenblat's formula outperformed the market over 17 years by wide margins. But during many of those years, it underperformed for long stretches. It tested loyalty. It invited doubt. And that's why it works. Because the few who can withstand the emotional storm are rewarded with results others never touch. Here's a real story. In 2012, a firm tried to commercialize the magic formula through a retail mutual fund. They followed the math to the letter. But the moment the fund underperformed for 9 months, investors fled. They couldn't handle the short-term pain for long-term gain. Within 2 years, the fund shut down. Not because the strategy failed, but because the humans using it did. Now, zoom into your own life. Think about a time you broke a routine that was working simply because you didn't feel progress. Maybe it was a diet, a workout, a savings habit. The discomfort of patience pushed you into the comfort of sabotage. And the same reflex applies to money. This insight is sharp. If your emotions don't align with your logic doesn't matter. That's why the formula needs your faith more than your skill. The math is the engine, but faith is the fuel. So what can you do? Build buffers, automate, turn off the noise, replace market watching with goal tracking. Train yourself not to win fast, but to endure smart. Because when the brain starts to scream, your job is to whisper, "I planned for this." Have you ever abandoned something just before it could reward you? Have you confused discomfort with danger? What if, from now on, you treated emotional discomfort as a signal, not to quit, but to double down on discipline? Because next, we'll look at the real X factor, the mindset that separates the quiet winners from the loud losers. And it's not what you think. The only edge that can't be copied. In a world obsessed with secrets, secret stocks, secret signals, secret AI codes, there's one advantage that no algorithm, no hedge fund, no high-frequency trader can replicate: emotional discipline. The ability to do what works, even when it feels wrong. The ability to not act when everyone else is. The ability to stick. Joel Greenblat's strategy isn't protected by patents. It's out in the open, you can Google it, you can download the data, you can follow it today. So, why isn't everyone rich? Because your edge isn't the formula. It's your ability to follow it when your ego wants to override it. Let's talk about Barry. In 2015, he adopted the magic formula. For 2 years, his returns lagged the market. He watched friends get rich on trendy biotech stocks. He started to question himself. But he made one rule: don't touch the portfolio until 5 years are up. In year 3, the market dipped and his portfolio held strong. In year 4, it surged. By year 5, he had outperformed nearly every one of those lucky friends, and did it with lower stress and less risk. His secret: not better picks, better patience. This is the cosmic irony of investing. The simpler the strategy, the harder it is to emotionally obey. Because simplicity feels like weakness in a world that rewards noise. But it's not weakness, it's clarity. It's strength that doesn't need to scream. In 2025, we're bombarded by temptation. Meme stocks, AI trades, financial TikToks, portfolio screenshots promising overnight riches. And that temptation feeds your doubt. Every swipe, every scroll chips away at your discipline. Until you forget, real wealth isn't loud. It's not flashy. It's not fast. It's built quietly, slowly, and with uncomfortable consistency. So ask yourself, what's the one thing nobody can take from you? Not your money, that can vanish. Not your knowledge, that can fade. But your discipline, that's yours. And it compounds faster than any asset class. Now, pause. Have you ever looked back and realized that your greatest wins came from the times you stayed, not when you reacted? What if, from now on, you treated discipline as your superpower, not your limitation? Because next, we're going to step into the moments that test discipline the most, market crashes. And you'll discover why the worst times can be the very best opportunities to fuel your machine. Why crashes fuel the machine. Picture this. A fire tears through a forest. It looks like devastation. Trees fall, smoke thickens the air, panic spreads. But what most people don't see is what happens beneath the ash. Growth. The soil becomes richer. Seeds that were dormant for decades awaken. And slowly, quietly, the forest returns stronger. Crashes in the market and in nature clear the way for renewal. For those who understand this, downturns are not destruction. They're discounts. Joel Greenblat's strategy doesn't fear crashes. It thrives in them. Because the magic formula looks for great businesses at cheap prices. And nothing makes great businesses cheaper than panic. In fact, some of the best entries in the formula's history came during recessions, not despite the fear, because of it. Let's look back. During the 2008 financial crisis, the world was in freefall. Banks collapsed, stocks plunged. But while everyone scrambled for safety, Greenblat's approach quietly loaded up on undervalued gems. By 2010, those positions had exploded in value, not through prediction, not by finding the bottom, simply by trusting the machine when it looked broken. Fast forward to 2020. In the COVID crash, value investors were mocked. Tech stocks soared. But then came 2022, a brutal tech reset. And guess who weathered the storm? The boring businesses with real cash flows. The kind Greenblat's formula seeks out. And those who had stayed in the system during the 2020 chaos didn't just survive, they accelerated. Here's the deep truth. When the world is selling great machines for junk prices, your job is to buy, not hide. The magic formula doesn't time bottoms. It buys logic in a sea of emotion. And the lower the price goes, the more gas you're pouring into your machine's tank. Let's make it personal. Have you ever sold in a panic? Ever turned a temporary dip into a permanent loss? What if, from now on, you flipped the script and saw crashes not as threats, but as golden invitations? Because here's the real takeaway. The times when everyone else freezes are the times your engine hungers most. It's not just built to endure storms, it's designed to eat them. Next, we'll explore what return this machine actually gives, and why beating a 6% baseline is the only standard that really matters. Beating the 6% line. There's an invisible finish line in investing. It's not flashy, it doesn't trend, but it matters more than any headline you'll ever read. That line is 6%, the historical long-term return of safe, boring bonds or broad market indexes. If your money doesn't earn more than that, you're not building wealth. You're just treading water while inflation quietly eats you alive. Joel Greenblat never promised 100% returns or overnight success. What he offered was far more valuable, a repeatable path to consistently beating that invisible line. With his formula, investors have historically averaged 15-20% annually when applied with patience and discipline. It doesn't sound sexy until you do the math. At 6%, your money doubles every 12 years. At 15%, it doubles in less than 5. That's not a difference in digits. That's a difference in destiny. Let's break it down. You invest $10,000 today. At 6%, in 20 years, you'll have $32,000. Not bad, but at 15%, over $163,000. Same money, same time, different mindset. One path keeps you afloat, the other buys you freedom. Consider Amira, a teacher in Ohio who followed the formula starting in 2010. Every year, she contributed $3,000 to a magic formula portfolio. Her colleagues mocked her for not buying hot stocks or getting into crypto. By 2025, her account had grown to over $140,000, more than double what her 401k had produced with standard mutual funds. She didn't swing for home runs. She just consistently beat the 6% line. And that's the real game. Because in investing, how fast your money grows determines how soon you're free. Free from debt, free from bad bosses, free from saying no to what you love because of what you owe. Here's the wisdom. If you can earn 15% returns for long enough, you'll outpace nearly every traditional path to wealth. Not because you made one brilliant move, but because you refuse to accept average. Ask yourself, have you been settling for safe returns because they felt familiar? Have you ever believed more than 10% sounds impossible because everyone around you told you so? What if, from now on, your new standard wasn't safety, but superiority? Because now that you know the benchmark, the next step is understanding why even the best benchmarks, like indexing, might still hold you back. And that's where we head next. Indexing, good enough, but not great. Imagine settling into a boat that guarantees you'll float, but never lets you sail. That's what indexing is. Safe, steady, but slow. And while it's better than drowning in speculative trades, Joel Greenblat made something clear. Good enough isn't the same as financial freedom, especially if you're willing to think differently. Indexing works because it's easy to follow and hard to mess up. It offers market returns with low fees and minimal stress. And in 2025, with apps like Betterment and Wealthfront, it's more popular than ever. But here's the trap. What makes indexing comfortable also makes it limited. You accept average by design. You anchor your future to the herd. You trade potential for predictability. Now enter the formula. It doesn't promise safety. It promises outperformance. Over years, not days. And the data supports it. From 1988 to 2004, Greenblat's approach returned over 30% annually, while the S&P 500 barely broke 12%. That's not a small edge. That's generational wealth. Let me introduce you to Sarah and Mike. They both started investing in 2015 with $20,000. Sarah chose a low-cost S&P 500 index fund. Mike followed Greenblat's magic formula. Fast forward to 2025, Sarah has roughly $40,000. Mike, over $80,000. Same contribution, same time frame, twice the result. Not because Mike was smarter, he was simply willing to embrace a better machine. Here's the hard truth. Indexing makes sense when you have no plan. But once you have one, especially one that's backed by decades of evidence, good enough starts to feel like standing still. And in a world where prices rise and time shrinks, standing still is silently moving backward. But there's another side. Indexing is emotionally easier. There's no doubt, no second guessing. And for many, that simplicity is worth more than the extra gains. That's fair. But if you're here, watching this, still listening, still searching, maybe enough isn't your endgame. So ask yourself, have you been settling for passive gains because active thinking felt risky? Have you ever looked at your returns and thought, this feels okay, even when deep down you knew you wanted more? Because what comes next will shift everything. We're about to unpack the anti-hedge fund mindset, why you don't need suits, signals, or supercomputers to win big. All you need is belief in the quiet path. The anti-hedge fund formula. Let's strip away the illusion. Picture a glass tower in Manhattan. Inside, a dozen suits, 14 monitors per desk, blinking algorithms, and $10,000 chairs. These are the hedge funds, armed with PhDs, satellite data, and models so complex they confuse their own creators. Now zoom out to a guy in Nebraska working from a laptop, using a two-metric formula he learned from a book. One of them will win. And shockingly, it's not the one with the skyline view. Joel Greenblat proved something radical. You don't need elite tools to outperform elite investors. You need a system they emotionally can't stick to. Hedge funds are brilliant, but they're human, and humans crack under pressure. They chase trends, they fear looking wrong, they abandon logic for prestige. You, on the other hand, you don't have clients. You don't answer to quarterly reports. Your greatest strength is that no one's watching you. In 2025, hedge funds manage trillions, but most still underperform the market. Why? Because they can't afford to be boring. They must explain every move, defend every dip. You don't. You can own a boring auto parts company with high returns on capital while they're trying to outsmart each other in biotech. They play chess against machines. You quietly compound. Let's talk about Daniel. He started investing in 2018 with just $8,000. Instead of buying flashy stocks or paying for robo-advisors, he built a magic formula portfolio. No tricks, no tweaks, just 20 stocks replaced annually. By 2025, he had over $25,000, outpacing even the fund his boss recommended. No one at his office believed him until he showed them the numbers. Here's the wisdom bomb. The market doesn't reward brilliance, it rewards behavior. The simpler your strategy, the fewer your decisions, the stronger your returns. Hedge funds try to win by being clever. You win by being consistent. So, look inward. Have you ever believed you needed fancy tools to succeed? Ever felt like the market was too advanced for you to beat? What if, from now on, you accepted that your simplicity is your edge? That your ability to stick to what works, without approval, without applause, is the reason you'll quietly win? Because we're nearing the end of this journey, and the final question remains, once this machine starts working for you, what will you do with all that freedom? What will you do with your freedom? You've built the machine. You've survived the doubts, the dips, the noise. Your portfolio hums along like a quiet factory in the background of your life, printing not just dollars, but options. And now comes the most overlooked question in investing. What is this money for? Joel Greenblat didn't just create a strategy. He left a clue. In the final pages of his work, he asked a simple, profound question. What will you do with all that money? Not in a flashy way, not like a Ferrari ad, but in a whisper, like a father asking his child what kind of life they want to build. Because the goal was never just to beat the market. The goal was to buy back your time. Freedom isn't about retiring at 40. It's about never being owned by a paycheck, a boss, a bill, or a bad decision. It's about saying yes to what matters and no to what doesn't. That's what this strategy gives you. Not fast riches, but quiet power. Take the story of Aaron. He started investing with the magic formula in 2012. 10 years later, he didn't quit his job. He didn't buy a Lambo. He funded his daughter's art school, his wife's bakery dream, and took 3 months off to care for his aging father. His freedom wasn't loud. It was invisible, but it was complete. The truth is, most people chase money and miss the meaning. They run the machine without ever deciding what they want it to buy. But you know better now. This wasn't about stocks. It was about sovereignty. So ask yourself, what would you do if money quietly worked for you in the background? What if your future wasn't dictated by raises or recessions, but by the quiet compounding of a choice you made today? Because this is where the formula ends, and your real life begins. The machine is yours now. You've made it. You've decoded the mechanics of a quiet fortune, one not based on hype or headlines, but on clarity, courage, and consistency. Over the last 14 insights, you've uncovered how Wall Street's greatest illusion isn't complexity. It's distraction. You've learned that behind every great fortune is not luck, but a disciplined refusal to follow the crowd. You now know the story of Mr. Market, the moody partner you don't have to listen to. You understand that good businesses mean nothing if bought at bad prices. You've seen how your edge isn't intelligence or timing. It's emotional resilience. You've met the 6% line and decided you can do better. You've unmasked the hedge funds and realized their billions don't scare you. And most of all, you've realized this machine is not magic. It's math, wrapped in discipline. But knowledge without action is just trivia. So what now? Start small. Build your first 10-stock portfolio. Watch how it behaves. Test your emotions. See where you flinch and strengthen that muscle. Set a rule. Once you commit, follow through for 12 months. Then 36, then 60. Let the machine work in silence while the world screams in chaos. And if this journey opened your eyes, don't let it stop with you. Share it. Send it to someone who thinks investing is too complex, too risky, too late. Remind them. The real edge is available to anyone brave enough to be boring. What does financial freedom mean to you? What will you do when your machine starts printing time? Because remember this one truth. The market may test your patience, but it always rewards your consistency. The machine is yours now. Use it wisely.